Good afternoon, everyone. So on behalf of Concept Investwell Private Limited, we'll be hosting a webinar today on the diagnostic industry. A very warm welcome to everyone, every participant over here. So today's presentation will be conducted by Zaid Munshi, an analyst at Concept. Now, Zaid has a 3-year experience in the equity space. He has worked as an intern with Unify and also as an analyst with ValueQuest, and he has been with us for over a year. So over to you, Zaid.
Thank you, Pragya, and welcome everyone. Thank you for taking out time in such a hectic result season. Thank you all and welcome. I'll try not to disappoint you guys a lot. So yeah, today's topic of discussion is diagnostic industry. The agenda for today. So basically, this is the flow of the presentation. First of all, we would be looking at why we should look at diagnostic industry. The diagnostic industry as a space is very well covered. Most of the top sell side firms, most of the banks, and most of the buy side firms knows how this industry functions, right? So there I won't be able to add much of a value. I will explain the industry, so to say, but the key focus of the presentation today would be the competition part and the displacement effect and the COVID wala part. So basically how things have happened post COVID, what was the euphoria that happened, how um, post COVID situation is, and the competition part where many players entered the industry. Industry wala part will be taken care of, and I will go in deep into industry also. But the core focus of the presentation would be this, why is it interesting to look at diagnostic space? So we'll first look at COVID wala part, COVID euphoria, what, how things evolved post COVID. And once COVID went away, what happened to the diagnostic players and their financials, so to say. And there is this new theory that came out, post COVID, that is called displacement effect. That I'll explain, and then is competition and everlasting pain. So there's a lot of new players entered in the space, whether uh, um, whether they will sustain or not, whether the current competition will be everlasting or not. Then after that, after understanding the whole space, we'll go to industry, that will understand the value chain, will understand the nitty-gritty of the industry from top to bottom, everything. And then we'll compare India with other countries, and we'll take USA as a case study for this diagnostic space. Post which we'll go to Indian insurance ka dilemma, whether health insurance in India will pick up or not, and if it will pick up, whether diagnostic industry will be the beneficiary or not. And then there is a new draft that formed post 2019, that is NEDL. We'll talk about that. And then finally coming to financials. So this would be the flow of the presentation. Before going any further, I'll just give disclaimer that whatever stock I'll discuss or whatever company, so to say, I'll discuss, there will be no recommendation for be it buy, sell, hold, anything. This is just for educational purpose, nothing else. Yeah.
So before we start the presentation, if you guys have any questions, you can type them into the chat box, and we'll be taking those questions at the end of the webinar. And this is a 1.5 an hour kind of webinar. So please keep your patience and stay with us. And I promise you, this will give you a much different insight into the whole space. Okay, Zaid, you can carry on.
Thanks, Ragya. Yeah, you guys can write questions in the chat box. So we'll start with COVID. So, how COVID, one second. Yes. So post-COVID, how things have happened, and post-COVID fall. Once COVID went away, what happened to the diagnostic? COVID was a blessing in disguise for diagnostic industry. Why so? If you look at the revenue of, let's say, Dr. Lal Path Lab, FY20 was 1330 crores, FY21 1600 crores, and FY22 2100 crores. Look at the CAGR. This is 2-year CAGR, FY22 over FY20. So 2 year mein they have grown on a compounded annual growth rate basis of 25%. Metropolis same thing 20%. Thyrocare 16%. Krishna 33. This was kind of extraordinary growth that they have seen. Industry, if you look at diagnostic industry as a whole, it is growing at 12-13%. Nowhere in the history companies have grown at such a great pace, uh, right? What happened? COVID. The COVID related testing, uh, be it RT-PCR, be it anything else, the COVID related testing as a percentage of revenue uh, came in out of thin air. COVID was not there before 2020, right? March 20 se COVID started, and then COVID as a percentage of revenue just jumped for Dr. Lal 20%, for Metropolis 23 in FY21, 16% in 22. Thyrocare it was 24%, FY22 it's 30%. Krishna, Vijaya, same thing that panned out. Basically, out of nowhere, COVID came and it gave a huge tailwind to the industry. Same thing goes for PET. Dr. Lal ka PET grown at 24% from 226 to 292 to 345. Metropolis ke numbers, if you see, it has grown at 30% CAGR. Thyrocare 41%. In the case of Krishna, there was a one-time expense in the form of convertible preference share. So there was an accounting loss, so to say. But if you look at the next 2 years profit, 185 crores, 68 crores. Vijaya 84 crores, 110 crores. So great amount of financial benefit that they have got, and the fundamentals have followed the market cap, right? So just even look at the market cap growth. If you look at April 19 to March 22 CAGR, Dr. Lal has grown at 35%, Metropolis 29, Thyrocare 14. From April 20 when COVID started, just look at the CAGR numbers, right? And imagine you are in COVID right now. Okay, imagine you are back in 2021. Everything is booming. The numbers are saying a different story, which has never been told so far. Everything is just firing. What happens in every bull market again happened here in diagnostic. We do some kind of madness in every thing, in every cycle, right? Here also we have done some kind of thing that we should not, and we can say in hindsight that we should not have done. This forthcoming few slides would be a total hindsight bias, and I am presenting you today because that happened. I didn't know, let's say in FY21, that this is going to happen. Abhi ye hua, isliye I'm telling you that these things we should keep in mind, going forward. One of our irrationalities would be the valuation. Just look at this table over here. If you look at from FY19 to FY21, this is market cap growth, basically the share price growth. Dr. Lal and CAGR. Dr. Lal in 2 years, it went up 61% CAGR. Metropolis 54 and Thyrocare 31%. But if you bifurcate that, majority of the gains were via multiple re-rating and not earnings growth. So re-rating played a very important role. From Dr. Lal, let's say 44 ka PE went up to 77, 40 ka went up to 63, 33 went up to 43. And there is some sanity post 2021 because COVID cases started falling down, right? EV EBITDA also the same story. Basically, re-rating led to the insane gains that we as a market participant have seen. What happens when everything looks too good, too sweet? First thing that that in this space, in diagnostic industry, companies did was acquiring at a very costly valuations. Dr. Lal acquired Suburban Diagnostics. Suburban Diagnostic is a Mumbai-based, Maharashtra-based pathology lab, which revenue, just look at the revenue growth of this: 150 crores, 170, and then COVID, 294 crores. Dr. Lal bought this in Q2 FY22, paid 925 crores for 294 crores revenue. out of which 167 was just COVID, right? 57% of this 294 crores is just COVID. Basically, for a EBITDA of 58 crores, Dr. Lal paid 925 crores. If you think of it from a different angle, it's like 6% RoCE के लिए इतना बड़ा payment किया. 58 crores on a capital of 925, just 6% RoCE. Dr. Lal historical RoCE ranges. Dr. Lal RoCE has went down, but currently it is around 25-26%. Paid for 6% RoCE this much. 3x FY21 sales, 7x excluding COVID, 16x FY21 EBITDA, 18.5x EV EBITDA. For the ones who know that, who are in the markets, they know that this kind of valuation paper is just too expensive, right? And this is not it. They paid 925 crores, but in Q2 FY22, when they acquired the company, they have a clause of paying extra 225 crores. Basically, total payment of 1150 crores. And that additional 225 crores payment was based on a FY22 performance. But that got derailed because COVID suddenly went away. See, we have to give them a benefit of doubt here. No one knew that COVID will go away, right? If you are in, let's say, September FY22 and you think that suddenly COVID will went away, no one, basically we were thinking at that point of time that, COVID is going to stay and we have to live with that. But COVID suddenly went away. No one has expected. So the second part of payment was adversely impacted and total payment was done just 925 crores. This was for Dr. Lal. Metropolis acquired high-tech diagnostics. Uh, for a 124 crores ka revenue, they paid 636 crores. And out of this 124 crores, 50 crores was COVID. So COVID as a percentage of sales was 40%. They paid 636 crores for 124 crores, basically 5x FY21 sales and 8 to 9x FY21 sales. For EBITDA margin of 40, and this 40% is inflated. Because of COVID, this got inflated. The same in the case here, where Suburban 20% EBITDA margin is inflated because of COVID. This basically, if you divide 50 divided by 636, you will get 8% RoCE. So RoCE that these companies earn is 25-26%, and in that period they paid hefty amounts for like 6, 7, 8% RoCE, right? So, and I want to show you here one of the best kind of advanced thinkers, which so basically Metropolis high tech का जब acquisition हुआ, so they hosted a call, they organized a call in which Ashish Kacholia, who works at Lucky Investment Advisor, he posted a very great point, so to say, and none of, not many are so advanced thinkers who have seen cycles. If you just listen to the commentary that he said on the Metropolis call. Just a minute.
There have been many great companies who have been built without, kind of doing acquisitions which are non-accretive, or, in the sense that they targeted RoCE over a reasonable time frame. Today the markets are hot, tomorrow the markets may not be hot. Keep the cash, use the situation when some of these guys, are struggling actually. The other option is that, over a period of time, you throw 100 crores at technology and build a technology platform which is absolutely bulletproof. Even today, our technology efforts are pretty middle of the road. There has been some improvement. But doesn't it just make sense to throw 100 crores at technology and kind of lick that problem once and for all and kind of make us the best in class? This kind of, 600 crores for a 40 crore EBIT. And if we keep doing this, just as a hypothesis, just say that, all the cash flows that we come up over a period of time, we keep throwing at the 6% RoCE kind of deals. Wouldn't our company's RoCE itself crash from where we are? Life is all about incremental. And incrementally, if we do 6% kind of RoCE deals, wouldn't the RoCE of a company crash from 50% to 6% over a period of time? Yes, you will say that, we are going to be cautious and we'll do 1 and 3 years. But look at the direction and, because there is a deal doesn't mean we have to do a deal. all the great value creation efforts in the country. Say you take HUL, you take Asian Paints, and there is such a large unorganized market. Anyway, a lot of them are going to die, and the strong players are going to take the market share. Why should we be in a hurry to throw away our hard-earned cash? That is just the thought process that I want to leave with. I mean, obviously you have your growth ambitions, but doesn't it just make sense to pause and think about this a little more? You know, we are good old solid businessmen. You've built a business over so many years with very very smart acquisition earlier. But today these acquisitions are coming in at humongous prices, and these are all being driven by the stock market valuations. Does it really make sense?
Right. So same concern. They paid huge amount of money for such quality businesses. But I think when your competitors are, making a lot of money, when the industry is in tailwind, um, and you don't, let's say, make a lot compared to your peers, then psychologically you won't be, the leader, right? And if they won't earn a lot, if they don't do, if they don't scale in this kind of period, then even in the analyst call, we will blame them that why aren't you scaling? Industry, other players are scaling so hard. Um, so this is, I think this is what one of the hindsight bias that I feel. Uh, but at that time, if you wear their shoes, let's say if I'm Amira Shah, then there is a lot of thinking went behind this kind of thing. But that's something in hindsight we are saying that that was wrong, right? Another uh, key exit was that Thyrocare, listed company acquired by a startup, which is PharmEasy. Both financials are way different. Just look at Thyrocare revenue, 500 crore ka revenue for 112 crores PAT, and PharmEasy. So basically, PharmEasy ka holding company is API Holdings. And if you look at the financials, the revenue is 2,300 crore for a net loss of 636 crore. Loss-making company bought a profit-making company, but at what cost? For a 500 crores revenue, they paid 4,500 crores. 66%. They bought 66% stake. If you look at like this, 14 times FY21 sales, 18 times excluding COVID, 40 times FY21 EBITDA, almost 40 times EV EBITDA. Very costly acquisitions. But that was a time when there was a lot of free money going on. The interest rates were zero. In the just last 1 year, interest rate went from 0 to 4%, roughly 4.5%. But at that time, the money was very cheap, right? And one thing that was very peculiar in this case was Dr. Money, who was the promoter of Thyrocare, invested 1,500 crores in API Holdings for 5% stake. Right. And see, API Holdings is not just into what's say pharmacy. They have different business also. They sell medicines online. They have different businesses. But just look at the valuation that he paid, Dr. Money, 1,500 crores for 5% stake. The valuation turns out to be 30,000 crores, June 21. At that point in June 21, combined market cap, including Thyrocare, Dr. Lal and Metropolis was 47,000 crores. Huge amount of acquisitions, huge expensive payment that they did, right? And it doesn't end here. When it rains, it pours. There were a lot of new additional players, and this time there were big pocket players that came in. Reliance acquired NetMeds for a 60% stake at a valuation of 5 times price to sales. FY20 sales of NetMeds was 221 crore and FY20 loss was 184 crore. That turns out to be 1,000 crore valuation. Orange Health, a new startup, entered diagnostic space. SRL Diagnostic, one of the pan-India chains in India already. They have 50% stake already in DDRC SRL. They bought the rest 50% at a valuation of 4 times price to sales. Tata, one of the most known and most talked about in the diagnostic space, entered diagnostic with a 60% stake in 1mg by acquiring 1mg at a valuation of 6.5x. Morgan Stanley entered via acquiring Sterling Aquarius. The deal data is not out yet. And Cipla entered with Akira by acquiring 21% stake. So basically, there was a lot of Adani. Even Adani is trying to enter diagnostic space via his subsidiary Adani Health Ventures. So there were, a lot of new entrants that came when everything was going just right. Post uh, these players, there were, players already in the value chain. They focused more into diagnostics, starting with Lupin. Lupin is a pharma company. It entered Lupin Diagnostic. It announced that they will launch Lupin Diagnostic chain in December 21. But if you see Q2 FY22 con call, so Lupin management said that they would not build much of expectation around this diagnostic foray. Their key focus would be the prescription business only, and they have grown like 20-30% more than the market on the prescription side. So the key focus would be prescription business only. Diagnostic is just a new area where they have entered. Fast forward to Q2 FY23, 1 year later. So again, the management said that the business is very small right now, and that's the reason why they have not been talking about this. So basically, con calls mein Lupin don't talk about diagnostic a lot. Okay, and so the management said that for the next 1.5 year, they'll give the business to grow, and then they'll start building ahead expectation. Basically, there's 1 year since launch, but there's no material development in the case of Lupin. Other thing, which is Apollo Hospitals. Apollo is a major in hospital chains. They started focusing into diagnostics via Apollo Diagnostic chain. Now, Apollo is a very peculiar case because they have built a lot of expectations around it. In FY21, they gave a guidance of 180 crores revenue. And in the next year, they said in next year, we'll say 300 crores. And in FY23, 500 crores. This was Q4 FY21 call. And the implied growth was 60%. And mind you, they were not acquiring any players. Okay, this is all just organic growth. They were not. So Apollo was the only company which I have seen in the call that said that we won't acquire anyone because current valuations are too high, right? But in Q4 FY21, fast forward to Q4 FY22, they said now we'll do 1,000 crores ka top line within the next 3 years. So which means FY25 they will do 1,000 crores ka top line. Now let's compare numbers with the expectation. FY21 they said 180 crores. They crossed around 166, more or less achieved. Hoping to, and in FY22 they were trying to reach 300 crores. That also they achieved. COVID went away. FY23 they were targeting 500 crores. Year to date, this is 9 months number till December 22. Last quarter numbers are not yet updated. So that is 271 crores. So obviously 500 crores doesn't look like achievable. And Q4 FY22, basically you are sitting here in FY22 and you are saying 1,000 crores ka top line within next 3 years, which is FY25 में 1,000 crores. Diagnostic as a space is very difficult to scale. Okay, and when you build such expectations into the numbers and the minds of investors, what happens is misery is always directly proportional to expectation, right? Cycle turned around. Higher profits, higher valuation, higher competition. What happens in the future? COVID went away, the revenue went away. This is year-to-date comparison. So Dr. Lal and Metropolis have posted Q4 result, but Thyroid, Krishna and Vijay have not posted. So I have just to compare it on peer-to-peer basis, I have taken year-to-date, which is till December numbers, December 22. Revenue went down, EBITDA went down drastically because there was a margin compression. So margin went away for like every company. And same with the PAT. Sorry, PAT also from a 345 from a 284 crore year-to-date PAT, it's 182, negative 36%. So basically, the insanity in growth that we're seeing in COVID that went away, and fundamentals followed market price. From the peak, if you see, Dr. Lal is down negative 57%, and this data is updated till 29th March. Metropolis negative 65%, Thyrocare 71% from peak, Krishna 55, 38. We are coming to at least some senses, so to say, because there is derating that happened. We realized that this kind of growth won't sustain because COVID was not there. Uh, COVID will not be there. There is Metropolis derating, Thyrocare derated. Krishna was already very cheap, so re-rated because numbers also. Krishna is into a different business segment, which I'll talk about in the industry wala part. And Vijaya also derated from 75 to 51. So basically, market price जो भी गिरा, that was because of both multiple and earnings growth. It's not just multiple derating, but earnings also contracted. And here we are taking COVID as a base, which was one time. And when I'll do the financials, I'll tell you what non-COVID revenue growth was. So basically, COVID came, COVID went away. Market price corrected up to a certain extent, and a lot for a lot of derating and earnings degrowth. Now, whenever these kind of things happen, we try to justify things. So one of the justification that I have seen in the industry and by talking to analysts and reading reports is this new theory which is called displacement effect. What is displacement effect? See, displacement effect is a theory, is a scientific theory which states that post every pandemic, immunity of humans gets strong. We tend to get less ill, and hence, not so beneficial for the diagnostic change. Post every, so this is COVID ka example. So immunity went away, and then long-lasting immunity for long-lasting immunity from the next 12 months, right? So there is no such data that is backing this theory till date, and I've tried a lot of things to back this up. So I've collated few cases, dengue, chikungunya, TB, how many people get ill post-COVID. And surprisingly, yes, people did get less ill, but there is a lot of bias in this slide alone. First of all, there were COVID-led restrictions. Maybe people didn't go to the diagnostic chain or doctors because there were lockdowns, there were some restrictions, there was home therapy and stuff. So dengue cases also went down, chikungunya, tuberculosis, and J is also cough and fever. But there is a lot of sampling bias also. See, this is just 4 diseases. Healthcare has a lot of disease and that impact overall diagnostic space. But this is the only data that I could got from the Ministry of Health annual report and few other sources. So yes, cases did went down, but did go down. But the point is, we cannot just justify that yahi hua hai. And yes, COVID, non-COVID volumes भी decline हुए हैं post-COVID for the listed companies. But I won't be able to justify because I don't have that much data backing it. So this is the first theory, displacement effect. Secondly, coming to competition. So this would be the key part of the presentation. Competition. Is competition disruption sustainable? Who will sustain? Non-COVID, non-discount players, discount players, or both? So starting with price war. One of the most viral and famous ads of Tata 1mg is 100 rupees test for thyroid, liver, diabetes, just here, right? So these are the first 4 are the high price incumbents where you see a lot of red, and the rest is the low price discount players where you see a lot of green. So these are the discount players where they are charging less for the test, and they are charging high, right? Starting with Hellions, just looking at the numbers, you can clearly say that Hellions is one of the cheapest in the industry. Hellions is a startup based out of Gurugram. right? They started in 2015 and they have expanded to more than, I think, more than 250 cities by now. And they are the first one to advertise in IPL. They have spent 80 crores to advertise in IPL. If you look at the numbers, revenue went from 40 crores to 67 crores and then 167 crores. Huge jump in revenue, but obviously loss making. Now, the key question that comes around competition is that, is this pricing, the predatory pricing or the cheap pricing, the way to acquire customers? Is this sustainable? So this is the question that in one of the interviews, Deepak Sahni, who is the founder of Healthians, asked. And let's just hear to what he has to say.
What is your view on competition? Because suddenly we're seeing a spurt of players in the healthcare space, specifically when it comes to diagnostics and other services, specifically when it comes to home-based services. So how do you deal with this kind of competition? Is pricing an important driver to get more consumers on board?
Pricing is an important driver only for the first time. I think the important driver is the service and the kind of differentiation that you show them. So it might be a consumer who's testing you for the first time and probably choose you because you were priced less or a price higher. But this is more of a repetition business, and it is not a one-time business. And you are actually connecting to a consumer household and not just the one consumer. You want to get a whole household as your consumer, and that is the reason it is more about the service and the differentiation that you show. So if to win over the competition, the best thing is to really look at the service delivery that you're offering in and offer a superlative service to your consumer all the time, and ensuring that it goes really, really smooth for him. Also ensure that the customer has to do the minimum or has to do a minimum effort while he is actually using your service. If he's really doing a lot of efforts to enable and to get to the service or to book the service or to really get the service completed, then you're not actually solving the entire problem. So we have always been focused on how do we really make it minimal for him, and how we make it really, really easy for him and the entire family, from a booking to an entire collection to anything. So if you really focus on that particular agenda, I think that's where you are actually winning the consumers and their trust, and the word of mouth goes viral at that point of time, and that's where we have built the brand for.
Yeah. So bottom line is quality over price. All pricing is just to acquire customer for the first time, but then you have to give service to retain that. So in other interviews, he said that 70% of the tests that are been booked at Hellion are routine tests, be it urine, thyroid, liver, etc. And one of the things he said in the interviews was that competition that he sees emerging are smaller than us. Basically, Hellion se bhi chote. So is he talking about smaller unorganized players? I don't know. Maybe he is thinking of competing with them rather than the big chains at this point, given the scale. Second, and the most famous entry was Tata. Tata bought 1mg. 1mg was incorporated in 2015. Now 1mg is also into selling medicines, and their revenue also comes out of some advertisement also. So we cannot just look at the total revenue. We have to see at the breakup of revenue. So diagnostics in FY22 was 186 crores. So if you see Healthians and Tata 1mg, both have grown as more or less similar range. If you look at the scale, so it's not like just because Tata entered, and obviously Tata entered late in the game, so we don't know uske baad numbers kya hue. But still, matlab both entered, both have scaled at the same pace. And just one thing, so in FY19 and 20, they gave the breakup of diagnostic services, but in 21 and 22, they clubbed diagnostic into a head called sale of services. So there is also shipping and ad revenue baked into this 115 and 186. So I don't know diagnostic उसमें से कितना है, but more or less, yeah, you can say कि ठीक है, Healthians and Tata 1mg both grown at the same pace. Now, one of the interviews that Gaurav Agarwal has given post the ad of that 100 rupees wala part. So he said that the discount are given in the top 30 to 40 routine tests where there is a lot of volumes. So see, you give blood sample to a diagnostic lab. They mix reagents. So basically, reagent is the chemical that they mix to get the report out of your blood to get basically the final result. And that reagent comes at a cost. So you have to use that reagent more efficiently to, so that economies of scale plays in your way, right? And they said, "Okay, wait, okay, abhi it's 100 rupees, but they will increase the price. But yeah, from the current levels, even if they increase the price, they will be 30-40% lower than the current prices offered by the non-discount players." So yeah, matlab, there is a threat, and diagnostics as a space, you say कि ठीक है, diagnostic is a area where trust is a very important factor, and Tata comes with a trust. And I think this is one of the most smartest thing that 1MG did was, tying up with Tata, because Tata is a trust. Tata comes with trust. So yeah, we have to see how they scale up from now on, because now COVID is not there. So numbers have to speak for itself. But till date, we have not, we cannot just justify that, they have scaled up because of Tata. Scaling is very difficult. There is there is a very low entry barrier, but scaling is very difficult. And how to generate scale in diagnostic or in any industry? By getting old, basically by surviving. Let me give an example. Pathkind Labs, incorporated in 2016. Now here I'll compare a non-discount company, which is Pathkind Labs, to Tata 1MG and Reliance, who are the discount players. Just look at the revenue and profit. The Pathkind Labs, which is a non-discount player, performed better uh, than the discount players. Be it profitability, so Reliance is a pure diagnostic player. You can compare profits and revenue. You cannot compare loss and diagnostic revenue with Tata 1MG, but yeah, uh, basically they performed way better than what these discount players have performed. In one of the interviews, Sanjeev, who is the managing director of Petkind Labs, he said that, in diagnostics, you can't just achieve scale by having deep pockets. You need quality service so that doctor endorse the lab. Doctors doctor's prescription drives 60% of the market. Basically, doctor जहाँ बोलते हैं वहीं जाते हैं. It's not like um, the doctor signs up and you go to somewhere else. It may be the case some of the times, or majority of the times we go where the doctor says, right? And uh, doctor also, proximity to the doctor is also very important. Um, if you go to a doctor, he or she won't say कि भाई यहाँ से 5 किलोमीटर दूर है, वहां जाना है आपको टेस्ट कराने के लिए, जो बाजू में होगा वहीं पे बोलेंगे, given that it is routine test. If it is a specialized test and they are in the diagnostic lab where they referred, if वहाँ पे वो टेस्ट नहीं होता है तो then it is a different thing. But for most of the tests, you will see proximity plays a big role in diagnostic. Second, there are also a lot of barriers like logistics. You have to collect sample and take it to the center where you use reagents and get the final result out of it. There's a staff training. There's some IT reliability. There is accuracy of the report that matters. In diagnostic, if you see standalone labs, which is the independent labs, was 53% in FY11. It went up down to 47%. Basically, 6% share loss in just 10 years. Organized chains, which is hospital-based labs and organized diagnostic chain. This is the independent uh, pan-India chains and regional chain. Uh, Dr. Lal Metropolis comes here. And this is hospital-based labs. जो hospital में एक laboratory होती है वो. They gained just 6% in 10 years. Just 6%. Just see how slow the process goes, right? And just to see how scaling is difficult, let's look at the data of the players who have already scaled, right? Dr. Lalpat Labs, incorporated in 1995, took 14 years to generate 100 crores revenue. Metropolis 30 years, Thyrocat 12 years, Krishna Diagnostic 8 years. Now I understand that, 1 crore today is worth way less than 1 crore in 90s and all. Time value of money and all is okay, but just to give you the perspective that, how much difficult and how much time consuming scaling is in diagnostics. From once you get the scale, see, once you reach 100 crores, then 100 to 500 crores in 5 years, 500 to 1000 crores in 4. And then only company that is around 2000 crores is Dr. Lal. Rest is Metropolis, and Thyrocare is around 600 crores. Krishna has not yet reached that mark. Dr. Lal, profitability, look at profitability from loss making to 50 crore. It took 18 years for Dr. Lal. Metropolis 35 years, Thyrocare 13 years. From 50 to 100 crores, 3 to 8. Right. So once you get the scale, economies of scale plays in your favor. You tend to get bigger and bigger. And just to tell you, see, Thyrocare was a discount player. Thyrocare cut prices of thyroid tests, but still they took all more than 10 years to get to that scale. Right. And yeah, you can debate that, look here, they have crossed 200 crores in just FY21. But this is COVID. COVID was a big beneficiary here. Once you remove COVID was a tailwind for the whole industry. If you remove COVID from the equation, industry is very much stable, right? Um, and just to show you some analogies that, we say that, free stuff, uh, promotional uh, cashback offers and uh, works. So Google Pay once was giving cashbacks. Today, you don't see Google Pay giving cashbacks. Geo launched in September 16. Most famous disruption in telecom. This is Airtel ARPU. ARPU is basically average revenue per user. So how much Airtel makes per user is what this number is. March 16 May ARPU was 194. September 16 Geo entered. In March 18 ARPU almost halved, right? 50% down. Now we are back to that level. It's just a matter of time. No one can um, sustain this, and this is Reliance we are talking about. No one can sustain that kind of low pricing, right? At least not in the history we have seen. And see, disruption happens when it's more like a win-win for both consumer and the uh, supplier. Here in diagnostic, Tata 1mg, Reliance, they are giving huge discounts, and that is very much visible. But that is more win-win for the consumers alone. It's a very big loss for the suppliers, which is Tata 1mg, Reliance. They are making huge losses. How much they can sustain that time, only time will tell. I don't know. But one thing is for sure, this won't sustain. Swiggy or Zomato is the other where now you don't see discounts or a lot. And now you have to find कि भाई AU का card किसके पास है, and that also you can use that promo code only 2 times a month. So basically that this is something that is um, as per my view, this won't sustain, but scaling is very difficult. Now, what happens when you can't scale enough? Let's take a case study of Mfine Labs. Mfine is also a diagnostic player which do pathology test and radiology test. It incorporated in 2017. Look at the revenue. Now remember the revenue that Tata 1mg Reliance 200 crores के आसपास का. Mfine could not scale that much. Net loss, huge net losses. Business restructured in May 2022. They laid off 500 employees. They merged with Lifestyle and raised 640 crores. They shifted their focus to corporate services and insurance partnerships. And what happened to their testing prices, which they were offering such cheap? So this is just common size of average test pricing across 7 major cities. March 2022 is the base year. So basically March 22 में जो test हो रहा था, that let's say if वो 100 rupees का है, आज वो 234 rupees का. Just look at the price increase that they have done in testing, or they could not sustain. Look at the other players, Redcliffe, MedPlus, Medibuddy. These all are more or less, startups or small companies, so to say. So maybe funding dried up. I don't know. See, rest are more or less stable, so I won't focus there. Focusing on the key one is Tata 1mg. In the last one quarter, so December 22 to March 23, they have raised prices. LDN seems to be the most aggressive uh, in pricing. They are cheap and they are staying cheap. Apollo Diagnostics, one of a very interesting case, because they surprised me. Apollo Diagnostic was 100 ka base, it's now 51. There can be a lot of things. Maybe the expectations that they have given, 180 crores, 300 crores, 500 crores, 1000 crores. Maybe that post COVID they are unable to reach. Maybe that's why they are giving discounts so that they can scale more. Maybe the pricing was already very costly. So, well, see, there can be many cases, but Apollo is giving discounts is something that I can see via numbers. Basically, what happens when you can't scale enough, you have to raise prices, right? And what now coming to what major diagnostic chains say about competition, starting with Dr. Lal Path. So the major competition is very intense in routine tests, the ones which have huge volumes, blood tests, urine tests, thyroid tests, the ones which have, which are reoccurring at a constant pace, so that you can bring operating leverage via volumes. At current growth levels, uh, Mr. Omchandra says that currently the industry is growing at around 10, 12%, 13%. Right? At this kind of growth levels, you cannot sustain the cheap prices. You have to increase the price, or else you'll hit the margins, or one day you'll be off the market, right? And see, diagnostic is a very non-sticky business. When you get ill, you go there. Um, Customer repetitiveness is very different. Obviously, it's across spectrum. There are acute, chronic diseases and all, but more or less, majorly, the customers are not sticky. And we have to see that, up Tata 1mg, Healthians kya karte hain? Basically now FY23, FY21, what numbers they post is something that we have to track. And so basically there was this question that, how is this kind of huge discounts possible? So again, the same thing that, if you could bring volumes, you can sustain the low pricing. And one thing that he said was, it is unorganized to organized that is happening. Previously also, top chains were against, fragmented unorganized market. But now the competition is visible because organized players have came. Previously, competition was there. Competition is nothing new. But now Tata, Reliance, Adani is going to enter. So this is much more visible. And that's why we are talking about it. पहले भी competition था, nothing new. If you read Dr. Lal Path's FY16 annual report, you will feel that first of all, whether you are reading FY16 or FY22 annual report, it's the same thing. Price बहुत ज़्यादा है, price competition is there, margin erode हो सकते हैं, there's a huge of fragmented market. Everything is the same. Nothing has changed. It's just that COVID gave a big boost, big players entered, and now we are talking about it. Coming to Metropolis. Metropolis, Amira Shah, she said that, the current cycle is much more like 2012 to 2016, where, a lot of players entered in the market, but only few could survive. Now, before going any further, let's study that cycle, 12 to 16 wala period. Because, a very famous quote by Mark Twain that, history doesn't repeat itself, but it often rhymes. So it's very important to study the history. In 2012, 12 to 16 ka period was a time where there were a lot of, virals going on. Swine flu broke out. There were chikungunya cases, dengue cases. There were some compliance strictness that government was bringing in the industry. That led to sharp jump in PE deals. Same cheese jo abhi hui, where private equities are backing, companies. That obviously slowly faded away with time. But During that period, the private equity companies were backing the players who were trying to gain the market share by pushing prices lower. This we are talking FY 12-13, right? And same cheese M&A activity in the Indian diagnostic phase. This includes the listed space, Dr. Lal, Metropolis. They have also done acquisition during that period. पूरा market boom पे होता है, ये लोग भी करते हैं acquisitions. Nothing new, right? So a lot of players entered, lot of PE backing, but how many were able to scale? These are few companies. So over 100 crores, so basically sales, EBITDA, and PAT. Over 100 crores, there are hardly 5 companies. And these are FY19 numbers. I'm talking FY 12, 13, 14. I'm talking directly FY19. Only 5 companies crossed 100 crore sales. 50 to 100, mein there are many, and there are less than 50 crores. And only 4 companies that generated more than 10 crores PAT. No one were able to scale. Coming back to Metropolis. The other statement that she said was, competition is trying to capture the wellness wala part, which is, see, wellness is something, wellness and preventive, wellness or preventive space is something that you go to the doctor or the lab to get tested without any disease. You just go for preventive checkup, ke bhai sab theek hai ki nahi, right? And this is a test decision influenced by the doctors. So acute disease mein 80-85% का जो test decision that is influenced by doctors. Chronic में 80-85% is influenced by doctors. Preventive में also. So this is taken from the investor presentation of Metropolis. Preventive may be, around 65-70% is influenced by doctors. Because you go to the doctor and say, "Bhai, मुझे ये सारा body check कराना and where to go." So this is what they have said. But just one thing which I want to highlight here is in preventive testing, if you are thinking about taking a preventive test, you are already in the top-notch category in terms of income. And I am not talking about pricing here. कि भाई 1000 रुपए में full body checkup डॉक्टर लाल दे रहा है, 10 टेस्ट करके दे रहा है, मेट्रोपोलिस 15 टेस्ट करके दे रहा है 1000 में. आई एम नॉट टॉकिंग अबाउट प्राइसिंग ऑफ द टेस्ट. आई एम टॉकिंग अबाउट money in general. India is still a mass market. People go to the doctors when they get sick, right? If you're thinking of taking a preventive test, you are already, beating majority of the population in terms of earnings, right? And then comes the second part that, kahan karana hai test. So there are a lot of data out there in the market which says कि भाई tier 1 में people don't think about price. जहाँ quality मिलेगा, जिसका नाम है, जिसका brand है, वहीं पे they'll go. In tier 2 and tier 3, there are people who think about money. It's not like सिर्फ महंगे वाले पे ही जाएंगे. Where there is value for money, they'll go there. So these are two area, groups that are there. But in general, if you are thinking of preventive test, pricing won't be a key concern here. And mind you, the new players are entering this space only. To get into the acute and chronic, you need to have strong customer or strong doctor engagements, and for that you have to go to the new areas, go to doctors and stuff, which takes time. Still time, they are just kind of aggregators where they just collect samples, they give it to different labs to get that tested, and then they pay to the and they give it back to the consumer. Till date, they have not yet expanded. Second point that Amira Shah said was tests are not commodity. Now this is very technical point, so to say. She said that a liver function profile of one lab is not the same as another, right? And we don't understand as a consumer. Doctors understand the nuances, right? And to build doctors' trust is it takes time, right? See, if you are a new diagnostic chain, and let's say you went into an area जहाँ पे doctors हैं, and and you set up a lab there, you go to the doctor. Now understand, that doctor already has um, um, contacts with the already existing labs. So it's not like आप जाओगे और आपको मिल जाएगा. They already have the contacts with the current uh, running labs, right? And to build trust is it takes years, right? It cannot be earned over time. The real question, and say trust for doctors is very important. Diagnostic is roughly, let's say, 5 to 6% of total healthcare cost. Let's say you get admitted to a doctor, to a hospital. तो वहाँ पे diagnostic cost won't hurt you much because of बहुत छोटा element है. But it decides the course of your treatment. That is the thing जो uh, that decides what treatment you need, right? And if that goes wrong, patient won't blame diagnostic chain. Patient ये नहीं बोलेगा कि ये तो metropolis की test थी, इसका test गलत आया. But he or she will blame the doctor, right? For doctors also, it is very important to get that trust element. Lastly, Apollo Diagnostics. What he said was pretty much we already know is that intense competition is in just 25-30 frequently routine tests. Organized players won't fight for price. They fight for quality. They won't reduce the price, and that happened. They have not reduced the price. Apollo Diagnostic, on the other hand, if you look at the current data, they have reduced the prices, but other players have not. And yeah, means they short-term volume dip is possible because of this, but in long term, players will regain from the specialized testing. So more or less from the data and from the history, what we can judge is this is nothing new. This kind of competition, this kind of pricing war has happened in the past. Till date, Dr. Lal, Metro, Thyrocare have sustained, and if history is the correct parameter to judge, future, I think that this won't be a big dent on the volumes or volume. This quote, I think you could have read. I mean, Amazon would force all the Kirana stores to shut down. Uber would shut down all autos and taxi. None of that happened, right? So more or less, yes, competition came. Now there are big pocketed players. There might be some short-term impacts, but when you look at the FY23 numbers of Dr. Lal Metropolis, they have grown 15%. Industry growing at 12-13%, gaining some of the market share. So I mean, data, at least to me, is not backing that competition is going to kill the incumbents. This was the end of competition part. Now we'll move on to industry dynamics. So I'll request Pragya to have to tell me if any questions are there or not. So far till the industry, because now industry will continue and competition wala part अब नहीं रहेगा. I don't think there are any questions yet. Okay. Okay then. Starting with industry dynamics. Value chain.
Wait, Zaid, there is a statement made
Yeah.
by Meet Shah. It's regarding that Thyrocare and pharmacy part. So he says that I don't think that he has paid 1,500 crores. I think he left 5% stake in Thyrocare and they got converted into pharmacy stake, which got valued at crazy valuation. So just clarify the matter here.
Yeah. So I have checked this issue. So whatever reports and notes, the news I have studied, there was a confusion between this, but at the end, I think he paid 1,500 crores. Obviously, see, उसको पैसा मिल गया 66% stake बेच के, उसी का थोड़ा पैसा उसने pharmacy को दिया होगा. That is obviously the case. But yeah, more or less, the key point here is to discuss about the kind of valuation that they pay. That's all.
Okay, next question is from Kevin Gandhi. He is asking, what has helped non-discount players to survive despite price competition?
So non-discount, what was the
Yeah,
question?
what has helped non-discount players, like the older players, to survive despite price competition?
Okay, Kevin, just hold on to that question. जब भी मैं industry वाला part companies पे आऊंगा ना, I'll explain you the market share वाला part. तभी I'll clear this doubt. Just hold on to this.
Any more questions from the guest? I don't see any more questions coming in for now. You can continue, Zaid.
Okay, Pragya. Starting with value chain. So This companies listed on the left give equipments to diagnostic players. Equipment goes for free. Machine has no cost. They give it for reagent rentals. So diagnostic players just pay reagent rentals to this kind of companies. They don't pay for the machine. But the reagent cost has some amount of equipment cost baked into it. And they diagnostic players also know that. Right. And they have to, so diagnostic players have to promise certain amount of volumes of reagents, that will cover the machine and the reagent cost. These players give reagent and machine, but uh, the diagnostic chains can buy reagents from somewhere else also. That might be compatible with the machine. But then they have to pay for that whole machine. They have to, and that would be very asset heavy. And it's a very asset light model there. No one wants to, do any mischief, I think, in this. Just pay for the reagent rental, and if you cross the promised volume of uh, reagents, you'll get certain discounts on uh, the reagents. Right. Now, the key question that comes here is, if there is a threat of forward integration, uh, whether these companies will go into diagnostics. So I think it's a very different skill set. Diagnostics is a very front end job where you have to sorry where you have to face consumers, where you have to face people, where you have to face doctors. Here it's more like B2B. You don't have to you don't have to take a lot of hectic on, डॉक्टर का रिपोर्ट क्या है, उसको देना है रिपोर्ट, उसका रिपोर्ट देना है यहाँ पे, and it's a very front end job. Plus, not every company makes all machines. So for example, what makes let's say blood testing ka machine, but it does not make CT scan ka machine. So not every company has the capability to produce every machine, right? And so far we have seen that it is very difficult to scale. So why would anyone want to enter this? And if you look at some of the financials of this company, so these companies are listed. Some of them are listed, and they make decent 15-16% ROC, ROE, ROC. So there is lack of motivation, and I think it's a different skill set altogether. So um, there is, I think, no threat of forward integration, so to. And coming to backward business models. Now, there are majorly three business models in diagnostic space. First one is hub and spoke, which is majorly prevalent across players. There is collection centers, which is somewhere you go and give your blood sample. Uh, then they send that sample to satellite labs. Now, what is satellite labs? Satellite labs is it's a small place where you can do some amount of testing. If you look here, you can do less than 200 का test, and most of the routine tests can be done in satellite labs. So जो भी routine test वाला part आता है, that goes to satellite labs, and then they went back to collection center, and the report will be given to the consumer. If the test is more specialized, which cannot be done in satellite labs, it goes to regional reference lab where there is some capability of doing specialized tests, and there are more test menu, right? And if it's very specialized, that even cannot be done in regional, that goes to national reference lab. This is mostly the headquarters for major chain, where uh, roughly 4,000 plus tests can be done, all specialized, all semi-specialized, everything. So depending on the specialty, the sample goes and you get back the report. Now, a small part of collection center is franchisee model. Now, what is franchisee model? Basically, uh, you book a small area where you can take Metropolis ka brand, and you can collect samples from the consumer. You hire phlebotomists, the ones who take blood out of you, for example. You hire them, and then you send that sample to the logistic value chain of Metropolis. Right. If you just look at the number, FY16 mein, PSC means patient service center. Basically, somewhere you go and give your sample. In FY16, 160 was owned PSC. In FY23, it is still 260. Not much of a growth. But if you look at the franchise, 172, almost 2600. Metropolis have done, this is the company that has done majorly scaled via franchisee model, right? And so see, franchisee is a good way to scale, but you have to retain that franchisee partner. That is very difficult. You have to uh, say कि भाई तुम भी कमा रहे हो हम भी कमा रहे, you have to get here also, you need scale to survive. It's a revenue sharing model at the end. It's not like Metropolis gives them the fees or they give them the franchisee gives them the fees. Both need scale, right? And we have seen pet kind labs scaled back due to inability to retain franchisee partners. So far Metropolis haven't seen any case of uh, cutbacks from the model, but yeah, we have to track. Pet kind mein this has been the case, and hopefully if they can manage, they can do good. Second model is managed labs. What is managed labs? Labs owned by individuals or hospitals. So basically, you are an individual, you have your own lab. You are a doctor and you have your own lab, and maybe you are a hospital. That is a small part of lab there, and you don't want to manage that. You can outsource that to third party. Third party being, take any diagnostic chain, Dr. Lal, Metropolis, Hyroca, and you earn revenue share agreement on it. But most of the chains in India don't give managed labs ka data uh, in disclosures में. So I don't know managed labs वाला portion कितना है अभी. The third part is public-private partnership, PPP model. Basically, government hospitals invite bids from private players, and then private player invest, do all the capex, set up radiology and pathology tests, uh, and the tests that are being done in government hospitals are way cheaper than the private hospitals. Krishna Diagnostic is the only company that is present in PPP model. 70 to 75% of revenue of Krishna Diagnostics come from PPP, and it is one of the leader. It has 78% bid win rate. If उसने bid किया, 80% chances it will win the bid, and there are no bad debts so far. And see, healthcare is a very sensitive topic, even to government, even to population. If you do something bad in healthcare, there would be very bad consequences. So obviously, both for the government and for the consumers and for the players like Krishna Diagnostics, it is they have to maintain some kind of strictness. And the contract that they have is 2 to 10 years ka tenure with annual escalation price clauses. So these are the three major business models that are there. Now coming to the industry size wala part. So diagnostics industry is a very small part of a very big sector, that is Indian healthcare. So 7 to 7.2 lakh crores, if 9 to 10% is diagnostics, which comes out to be around 69 to 72,000 crores. Right, in diagnostics industry has grown at around 12 to 13%. If you look at the share of pathology and radiology, that has remained more or less stable. So pathology is a larger part, uh, taking around 56% share. Radiology taking around 57% share. Radiology around 44% and 43%. So more or less it's stable. Now I'm just recalling this chart from which I've shown in the competition wala part. So just to remind you that 6% share standalone labs ka gaya and 6% gain हुआ है organized players का. Now focusing on to FY22. FY22, 47% standalone, hospital 37, and organized chain are 16%. Out of the 16%, only 35 to 40% is pan-India chains, where the listed players comes in, and others are regional chains. Right. Now we'll bifurcate each part one by one going forward, starting with pan-India. Then I'll bifurcate pathology and radiology, and then I will bifurcate B2B, B2C, and some of the other parts of the industry. Right. So starting with pan-India. Not all pan-India chains that say they are pan-India are not. Dr. Lal has 60% concentration in North India. 62% revenue comes from North. Rest is very small. Regional concentration. Metropolis has West and South concentration. Krishna has West concentration. Vijaya is purely South player, 96%. Out of the 96%, only there are two states, Andhra Pradesh and Telangana. Dr. Lal majorly in Delhi NCR, 32%, and rest of North is 30% out of the 62. Only reasonably diversified player is Thyrocare, which is quite diversified. So 25 North, 31 West, 26 South, East 17, and SRL other. South is a small part, but SRL is also majorly diversified compared to other players. Now, none made a big dent on the market share. Just look at so this is total market, include everything, standalone labs, hospital labs, big chains, everyone. Market share of Dr. Lal per FY12 was 1 to 1.5%. In FY22, it is just 2 to 3%. SRL 2%. Metropolis gained around 1%. Thyrocare gained around 0.5%. Krishna Vijaya 1%. Highly fragmented industry. If you just look at the organized chain, that 16% wala part, regional chains and pan India chains. Out of that, Dr. Lal is 11-12%, which increased to 15-17%. SRL 12-14%, Metropolis around 10%, Thyrocare 5%, Krishna Vijaya 4%. Highly fragmented industry. None company has that share, that big lion share. Now here I'll answer Kevin's question also, that how they were able to survive. See, in diagnostic, and here I'll answer any question if you have regarding scale, that why scaling is very difficult, and once you scale, you will stay there. First of all, industry runs on referrals, right? Referrals of doctors, that is around 60%. Walk-ins around 30-35%, and corporate clients, basically the big corporates, have some contacts with the diagnostic chains where you test your colleagues there. Now, it is very difficult to scale when majority of the business is referred by doctors, right? And here comes a very pertinent question that I heard everywhere, that how much commission we give as a diagnostic chain to doctors and clinics. Now there is no clear answer, okay? But I'll quote the book that I read here. So Dissenting Diagnosis is a book on Indian healthcare market. If you read that, therein it states that X-rays में 25% commission they give, MRI CT scan में 33% commission, and some of the pathology labs have 50% commission also. So yeah, this is very, very critical, but see, it's a very regional concentration specific subject. The one who answered this question was one of the doctor in Delhi, and he said that Delhi wale part mein aisa hota hai, more or less. And this book was published in 2016, so बहुत पहले की. It's like 2016, so उसके पहले लिखा होगा, so around 2016. And very critical subject, there is no clear answer to it. पूरे इंडिया में ऐसा होता नहीं होता है, I don't know. And whether this still prevails, I don't know. 85 to 90% of industry is prescription based. Basically, the ones who get ill go to the doctor. 10% is wellness wala part, right? And secondly, see, in India there are 1 lakh labs, out of which less than 2% are NABL certified. Reports accuracy is a question. So if I'm a big chain, big diagnostic chain, I can't just push growth by acquiring any of the uncertified labs, acquiring anyone in the market. I can't. You can't just push growth. Secondly, it's a volume game. It's not a price game. If you look at the realization, this is revenue per patient. Basically, the realization that Dr. Lal has, forget the differences. I'll tell you why there is a difference in every company numbers going forward. Currently, just focus on price growth. Just no realization growth. There is just volume game. So answering your question, Kennel, that why they were able to sustain, they already have context. It's not like Tata 1mg Healthians came into the market and every doctor shifted to them. They already have such kind of things, and see, it's very difficult to scale because doctors के साथ contact बनाना पड़ता है. There are not many labs that you can acquire and push your growth, and it's just a volume gain. You cannot increase the price. ना तुम price बढ़ा सकते हो, ना volume push कर सकते हो, ना ही you can increase your proximity just like that. You also have to be near to the doctors, right? Doctors का lab, like I said, doctor won't tell you that 5 kilometer दूर जाओ test कराने के लिए. So if it's a very sticky business if you are already there. That's how I'll answer that. Moving on to the supply side. Supply side is majorly urban focused. 60 to 65% industry is urban, where only 30% population stays. Whereas the rest, 72% population is rural, where only 40% industry. Basically, in rural India, जो भी test करने होते हैं, basic diagnostic tests are carried out in government hospital, but जो भी बड़े test होते हैं ना, they have to go to urban areas to get that done. And even in urban area, top 10 cities are concentrated. They are like 42% of the market. And this is pathology market. This is overall market. I could not get the hold of radiology or part, but this is total market. This is radiology. Sorry, this is pathology. Top 10 cities have 42% share, out of which 16% is tier 1 type cities, Bangalore, Chennai, Hyderabad. 11% is Lucknow, Pune, Surat, and their competition is very low. And you see, this is the next leg of growth. The Dr. Lal and Metropolis have acquired 6 companies in the last 2 years. Not in the last 2 years, in 2019, 2020. In that 2 years, they have acquired 6 small acquisitions in this area, Surat and Ahmedabad, and one also in Vadodara. In Delhi, Mumbai, which is very mature market, very competitive market, that is another 15%. So this is the supply side. Nothing more to add here because it's very urban focused, and we'll see how things pan out here. Coming to the key part, which is pathology versus radiology. And none is complete, right? Both have pros and cons. So I have bifurcated pathology and radiology into 2 parts. First, scalability, and second is pricing and margin, right? In pathology, the investment is very low. A simple blood testing machine will cost you 60,000, to some high end goes up to 12 lakhs also. But 60,000 say is the minimum amount that you need. Radiology machine, if you need a basic X-ray machine, you need 10 lakhs, and that goes up to 1 CR. So radiology is very capital intensive, whereas pathology is not that capital intensive. Lab operations are centralized. The hub and spoke model, where you are testing every sample in one place and getting samples from all the spokes. Whereas radiology is localized, you need a machine and a patient. So patient interface is very high. You need patient to get that tested. Whereas in pathology, yeah, sure, in if you go to the lab, there you need to be there. But in B2B business, basically what is B2B? You collect samples from hospitals, nursing labs, etc. And they give collected samples to the labs. So they don't have to collect samples. So there is a patient interface, and then thus business scalability is very high in pathology. Low investment, centralized operation, just collect करने samples, थोड़ा logistic strong होना चाहिए, and that's it. That's why it is very highly scalable. But to become profitable, you need scale. एक बार start तो कर दोगे, but barrier to scale is very high. Radiology में scalability is low because it's very localized and the cost of investment is very high. Coming to pricing. So before coming to this wala part, I'll first tell you few basics. New entrants have entered in pathology space. Radiology is relatively untouched, and the revenue split of the place. So Dr. Lal, Metro, and Thyrocare are majorly pathology players, whereas Krishna and Vijaya, they both have some part of radiology. Krishna has 55% revenue coming from radiology. Vijaya has 35%. Now, just keep this thing in mind, and I'll connect every gross margin, EBITDA, and RoCE number with that. So pricing and combination. First of all, from patient's perspective, the cost is low. A blood test, urine test won't cost you much as CT scan, MRI. वो 2-3 हजार से start होते हैं. यहाँ पे less than 1,000 में हो जाता है mostly. Per patient realization is low because basically what patient will pay is the realization. In radiology, it's high. In pathology, it's low. And patient volume is high. Whereas in radiology, it's low. Because per patient realization is low, gross margins are lower in pathology. Look here, gross margin for pathology players. Dr. Lal Metropolis, 75, 76%, 77, 78. So more or less 76%, whereas Krishna, Vijay. You have higher margins because you have high realization. You need, see here also you can scale, ऐसा नहीं है कि scale नहीं कर सकते, but you need very high scale. And the opposite thing is in EBITDA. EBITDA margins are higher in pathology because you have scale. And EBITDA margin are lower in radiology because you don't have scale, you need scale. If you see, so Thyrocare is a B2B player, so B2B wala part next slide mein, and I'll explain why EBITDA margins are so high for Thyrocare versus this players. And so Vijaya is not comparable because uska major part comes from pathology. But Krishna, so if you have scale, once you scale your business, you can even generate higher margins in radiology also. Compare radiology part of Thyrocare, very low scale. Look at the margins. Once you get scale, you can reach that 25, 26%, but you need that kind of scale. And RoCE is very obvious because it's lower investment, higher return on capital, high RoCE, it's low RoCE. Krishna ka RoCE is 10, 15%, whereas these companies run higher RoCEs. So this is basic differentiation between pathology and radiology. Both have their pros and cons. Coming to the second part of the industry, which is B2C versus B2B. There is a trade-off between scale and working capital. I'll explain why. First of all, let's understand what B2C and B2B is. B2C is direct patient walking. Okay, you go to the lab and you get tested. B2B is sample collected from hospital, standalone labs, nursing home. You collect sample, you give it to the labs. Key success factor here is doctors connect. You need to connect to the doctors for B2C. Logistical infrastructure is very important. Even now, home collection has become a trend. तो आपको घर पे आके आपका सैंपल ले जाते हैं, तो that infrastructure you also need to maintain. Here in B2B, you need low pricing and wide test menu. That's it. The more less price you can offer, the more business you'll get. Relationship with customer is needed. Competition is high in both. Actually. High because B2C में small regional labs है, and high in B2B because there are labs who have wide test menu already. There are labs. Competition is high. Barriers to scale. Now there is, okay, sorry, someone, okay, sorry. So barriers to scale is high in B2C because that you need strong logistical network and brand building, right? And basically, if you need to scale in B2C, you need more labs on ground in every city, every town. But in B2B, it's very low because you just need one big customer. That's if you converted one, you tell him that refer me to someone else, and then you grow your business more on scale because of on the volumes part. And thus, scaling is very difficult. Time to establish presence is 4 to 5 years versus 1 to 2 years in B2B. Now, before gross margin, EBITDA margin, I'll tell you what are the contribution of so B2C revenue contribution for every player. Dr. Lal is 72% B2C, Metropolis around 50%. Thyrocare is a major B2B player. 80% of revenue of Thyrocare comes from B2B business. Krishna is into different business model, so to say. It's not a different business model. It's a sub segment of B2B. It's like B2G, business to government. And 70-75% of revenue comes from P2P, PPP revenue. And Vijaya is 93-95% B2C. Now, gross margins are high in B2C and low. Why? Because in B2B you have volumes. So you have to tell him that मैं यहाँ पे less charge करूँगा, and per patient realization is lower by 20-30% as compared to B2C. EBITDA margins are low. see, gross margins are high, but EBITDA margins are low. Opposite case, because you have to spend on higher advertisement and phlebotomist costs, basically the ones who take the blood sample out of it. Whereas in EBITDA margins of B2B players are high because of volume, operating leverage. And receivable days, obviously B2B will have higher days versus B2C. Now let's compare, B2C player versus B2B player. Dr. Lal, Metro, per patient realization, more than 150 or 750, sorry. And in Thyrocare, it's around 360, or almost half, right? Cost per patient realization is low. You will charge less. Gross margin are high. Like cost realization is low, gross margin flows down to that, but EBITDA margins stays up, stays opposite story. EBITDA margin is 25-28% versus EBITDA margin 36-39%. Once you build that scale, once you have that kind of volumes, then operating leverage will come and play. But to get this kind of EBITDA margins, you need working capital. Cash conversion cycle for direct, correlation with B2C and B2B. So B2C, more the B2C part, more the negative working capital. Metropolis, negative working capital. Only player which has higher working capital is 40 to 60, which is Thyrocare, which is a 80% B2B player. Vijaya, most of the part is B2C, negative 131. So this is the thing. Basically, you have to it's a trade-off between scale and working. If you want to scale in B2B, you need to have that kind of and to have working capital. Next slide. So the last part on the industry is this higher specialized testing. So post the post competition entered the market, there is more like noise that you have to go more specialized where there is less competition, high realization. But one key thing to note here is higher specialized testing means high realization. But in specialized testing, the reagent cost is very high. So your margins will shrink if you don't have volumes. You need volumes to compensate for that reagent ka cost. So even if the realization is high, margins are low, unless you get that scale. If you look at the bifurcation, Metropolis has 25-30% routine, whereas Dr. Lal and SRL have higher share of routine. Now, if you see the revenue per patient, so SRL ke numbers are not there because it's not listed. Metropolis and Dr. Lal Path, if you see, Metropolis always have upper hand in realization. Why? Because higher specialized testing. The more the specialized testing, the higher the realization is. But again, margins may be Metropolis has scale, so it's not like margins. EBITDA margins are way different for both Dr. Lal and Metro. More or less, both are in same line because Metro has margins, scale. And competition is intense in this routine wala part. Which is largely automated. You don't need manual intervention in that. It's majorly high margin business with least manual intervention, and now one key thing that is happening in the industry is people are players have started bundling tests. So basically 10-15 tests within 1,000 rupees, 1,500 rupees. What that means is basically you need just one sample for that lot for that testing. Your volumes, basically your cost will reduce because you just need one instrument and sample, and you are churning the reagent more, the same reagent for more number of tests. So that's the reason your cost will reduce, and you will get higher margins in bundle test, and that's the reason it is increasing. Now coming to the global part, is India comparable to other countries? This is India, where it's a growth market, industry growth at 12-13%, market structure top 15%, just 11-12% share, and this is healthcare insurance penetration. So for this healthcare insurance penetration, I have taken total penetration, group plus retail. See, retail is very small in single digits, but group is very high. So this penetration includes that group wala part because we are comparing it with other countries. First, let's compare with mature markets. USA, Europe, Australia, Japan. Growth rate is much lower than India, but the share market share structure. So in USA, there are two players, Quest and LabCorp. They have around 20% share. In Europe, there is no single leader. There are 15,000 labs. In Australia, there are two players constitutes 60 to 80%. In Japan, 12 top 2%, 20% share. But healthcare penetration is very different than India because they are developed markets. Apart from Australia, everyone has almost all the population insured. So first of all, it's not a peer-to-peer comparison because growth rate is very low, first of all, and then healthcare penetration is way higher than India. Comparing it with the growth markets, which is China, Brazil, Indonesia. Uh, Still, India is much uh, faster growing than even the China, Brazil, Indonesia, the selected countries. Market structure, top 10 chains in China have 30% share. Brazil, top chains have 20-25%, 30-35% in Indonesia. Still, India is way lower than if you compare it with even the growth countries. Basically, Indian chains have not yet gained that amount of market share yet. And China is almost fully insured. Brazil and Indonesia is way behind India in ensuring health in ensuring people for healthcare. So growth rate is higher, but yeah, penetration is not there. So basically, there is no apple to apple comparison. But we compare everything with USA. Right? So there is a case study that I did on USA Diagnostics. Uh, Hospital care is directly proportional to insurance. Why I said that? Because USA is insured totally, almost all the population is insured. And if you see, 58% share is hospital-based labs, which was 54% in 2008. 2008, when the market size was $52 billion, which became 82 billion, basically 4% CAGR. But uh, independent labs did not lose a lot. Quest, which is one of the leader in 2008, 13% share, lost some of the share, whereas LabCorp has maintained the share. And you see, both these companies have grown via acquiring other players. This is the case across countries. Industry is fragmented, players are acquiring. But there is a big difference between Quest and LabCorp acquisition. Quest acquired companies to increase the patient coverage and geography expansion. Basically, Quest is just acquiring to increase its reach in every state, in every town. LabCorp, on the other hand, they acquired more for new testing technologies such as gene sequencing, NMR. So NMR is basically your body image in a better resolution. So LabCorp is innovating, so to say, innovating new tests, coming with new tests. Quest is just acquiring uh, to expand uh, the reach. Quest lost some of the share. LabCorp has more or less maintained. Quest revenue, acquired revenue was $1 billion. FY19 revenue was 7%. So basically 15% of the revenue that Quest has as on 2019 was acquired. LabCorp has 40% acquired revenue, more than $3 billion of acquired revenue, which is more like 44-45% of acquired. You look at the margins, margins are more or less stable, 23% in calendar year 2005, CY13 met 12%, CY19 met 20%. So there was competition in US also. There was hospital-based labs ka concentration there, but still chains have, and this is average of both Quest and LabCorp. They have maintained the margin. Basically, what insurance can do, if you go in a hospital in US, that the charges for the test that they do, that they charge is 2 to 8 times higher than the national lab. Basically, if you go to a Quest lab or LabCorp lab, you will be much more cheaper. But if once you are insured, you won't care. जहाँ पे भी insurance का पैसा जा रहा है, we are not paying out of pocket. right? So you will go in hospitals, it's very obvious, even if it's of low cost. In India too, so basically Quest and LabCorp has some of the hospital managed business. So basically some of the hospital, they manage their diagnostics. But in India too, there is this model that manage them, but they don't give any disclosure as of now. So I don't know how many chains are managing hospital labs as on date. Insurance played, a very big role in for USA. Can in India it make a big dent on volume? If you see the plans which includes health checkups versus plan without health checkups, the premium that you pay for including that health checkup is 25-26% higher than when you include without health checkup. And this is just individual health plan for a sum assured of more than 5 lakhs. Even if you take 5 lakh ka sum assured per family of 4, the premium stays at 26-27%. So if you want health checkup, you have to pay more, 25-26% higher premium. Let's say 9,800 ka average premium you have to pay. Whereas if you don't want, you have to pay 7,700 average. But there are some dilemmas that I have post reading on insurance that I have seen that new policies, whatever new policies that have been issued, 40-60% of the new policies have preventive health checkup in that. जो भी नया insurance ले रहे, they are opting for preventive health checkup, but the utilization rate, which is the percentage of customers who avail health checkup, are very low, low single digit. Second thing is the unwanted clauses. So basically, there are in some policies there are clauses like 3 years of no claims before being eligible for health checkup. So you have to not claim for 3 years to be able to get that health checkup. And insurance companies prefer low cost. They will prefer players who are giving, who are testing the sample at low price. So this makes insurance segment a bit less attractive for the national chains, because first of all its margins में थोड़ा problem आएगा, plus bargaining power of insurance would be way higher than diagnostic chains. So this is insurance. So basically bottom line is insurance is like we are talking way long term. Insurance will take a lot of time in India to make a dent on volumes. NEDL, the recent draft that was drafted by ICMR, Indian Council of Medical Research. So NEDL is nothing but government has drafted 150-160 essential tests. For that test, operational infrastructure and regulatory guidelines have been given. No pricing cap has been given yet. There is no pricing, but it's just that कैसे करना है टेस्ट को, क्या accuracy होनी चाहिए, what are the cleanliness or management of the equipment that you have to do. That's all. It's so, and no pricing yet. You can see there are pathology, dengue, chikungunya, and other tests that they have curated, but there is no cap as on date. If there will be a cap in the future, volumes might cover up for the partially hit profitability. So basically, if cap lag jata hai, to volumes are expected to increase, that will compensate for that realization loss. And small players might find it very difficult to survive. Small players के पास वैसे ही volume नहीं होता. If they don't have volumes and there's a price cut, and let's say that is below their price of what they were offering, so it would be harmful for their profitability. And and that's the reason. One of the prime example is Maharashtra. In Maharashtra, there was a cap on dengue testing prices, which Bombay High Court halted on March 19. Why? Because the on-ground procedures were not followed. Um, Diagnostics is a service. It's not a product that you produce and sell. Small labs cut cost on, let's say, the management of equipment, the waste management. They don't maintain the equipment properly. So they cut cost on the compliance related expenses to maintain that margin. But that sacrifices the accuracy of the test. So this is the thing. I mean, yeah, the NEDL is a threat, so to say, and routine tests are mostly impacted by this, but we have to see how things play out. Coming to this financials, last few slides. Financials may, if you see overall, uh, okay, I overshot my time, I guess. I'll just fast forward this in few minutes. Okay, Dr. Lal has grown at revenue 14% in last 3 years, 15, 19 months. So more than market, every player has grown. So they have gained some of the share. Krishna Diagnostics alone has grown at 33% in the last 8 years for 37. They incorporated in FY11, FY23 they have 350 crores ka revenue. And see, Thyrocare has not yet announced the results. So Thyrocare, Krishna and Vijaya, these are 9 months versus 9 months number. So this 10% CAGR is 9-month FY23 versus 9-month FY20. Reagent cost is very high. So as a percentage of sales, reagent cost is 22% for Dr. Lal Metropolis because specialized testing, it's higher. Thyrocare because it's B2B and margins are low, and the realization is low. As a percentage of sale, it is high. And Krishna and Vijaya are into different segments. Radiology is one of the key component of that. So it's not comparable. If you look at EBITDA margins have stayed more or less resilient over the years. So for Dr. Lal and Metro, it has not been a reduction in margins. Krishna, this is one time loss and of convertible preference share. Thyrocare. So if you see Thyrocare, the margins were 38-39%, which we just saw. That reduced to around 28-29% in the recent times. Post acquisition of PharmEasy, there is a business restructuring where they are increasing their manpower cost. The manpower cost increase is hurting the margin. Profitability is not the same as revenue growth in at least a 3-year period. I'll come to the reason in the next slide. But 8 years, 12 years, more or less in line with what revenue has grown. Recent years, the profitability is not seeing the same growth because they have acquired players via debt, not huge. So basically, March 20, 129 crores debt of Dr. Lal, which increased to 420 crores. Metropolis 67 crores debt, increased to 266 crores debt. Debt bada, interest rate बढ़ गया, and new companies increase the depreciation. Depreciation and interest won't let the EBITDA margin ka flow towards that. But debt is not a big concern in this business because it's a very high cash generating business. It's 75% CFO to EBITDA every year on an average. So whatever they generate as an operating income, they 75%, more than 75% they generate as cash flow. And they have Dr. Lal has 838 crores cash on balance sheet. Metropolis has 100 crore cash on balance sheet. They have done a lot of acquisition. This is not the first time. Metropolis has done 24 acquisitions in 18 years. But this is some track record that Metropolis presented in their annual report. Quite fascinating, so to say, because they have turned around a lot of businesses. High tech, it's just started, and many more. These are just few that was stated in the presentation. There are many more, and same goes for Dr. Lal. They have also done acquisition. Just like even in USA, it was there. Even in India, it's like that. Now, one key point to highlight here is acquisitions leads to dilution of RoCE. See, Dr. Lal, Metropolis, they are acquiring players weaker than themselves. They are acquiring players which are loss making. So that will eventually dilute the margins unless and until they turn around. But turn around karna bhi, it's very difficult because it takes a lot of time. And this is structural decline. We are not talking about 1 year, 2 years. It is like 10 years, 12 years history. From 44, 50% RoCE, it came down to 20%. From Metropolis also same story, 32, 48, 45, 22% currently. I'll show you a different graph, which is increasing, which is Thyrocare. they have increased when every player was decreasing. Thyrocare was increasing their ROC. This is currently 28% because of restructuring of expense post pharmacy buyout, but they have increased the ROC. Apart from B2B, B2C difference, Dr. Lal Metro are B2B, B2C players. Thyrocare is a B2B player. Apart from that, one reason that I could uh, uh, grasp was the acquisition part. Thyrocare has grown more organically, whereas Dr. Lal has grown more by more acquiring more uh, companies. But that led to low scale of Thyrocare. Thyrocare so this is FY22 sales. Thyrocare FY22 non-COVID sales was 400 crores. Dr. Lal FY22 non-COVID sales was 1700 crores. If you don't acquire, you won't scale. If you acquire, ROC declines. It's basically a trade-off, and till when this continues, we have to see that how things pan out, how they turn around things. But at least in the history, they have diluted ROCs. Now coming to the final part, which is valuation. Before going to valuation, I'll tell you some of the intangibles that see price to earnings is not just a quantitative part. There are many intangibles behind that number that you see, right? It's not just कि इतना growth करेगा तो इतना PE मिलेगा. There are many corporate governance issues, past का track record कैसा रहा है and all backing that PE. In diagnostic industry, what I foresee is doctor-patient connect is one of the most important intangible where you need doctor ka connect, lab network because you need to have faster turnaround times. The more you, the faster you generate report, the better it is for both the doctors and the patient. Digitization is obviously the one of the case, and economies of scale. You need scale to survive, or else you won't survive. You have to either increase price or get more customers in lower price. And given this intangibles, I think post COVID there were a lot of reports that says कि अब diagnostic industry में कुछ रहा नहीं है, diagnostic industry is dead, players won't grow at the same levels. I agree that जो COVID में growth आएगी 20-24% वो नहीं आएगी, but they will keep on growing at what uh, they were growing pre-COVID 13-14-15%, and this is seen in the valuation. The market at the end is not stupid, right? You see the P ratio of Dr. Lal, only the COVID gains that have been wiped off. This is EV EBITDA. But Dr. Lal is still trading at pre-COVID levels or a bit higher than that. Market has just wiped off COVID gains. Look at the result of FY23 of Dr. Lal. 15% growth. Metropolis, 15% growth. Just wiped off the COVID gains, which is very logical, right? It was just one-time thing. Same thing for Thyrocare. Just wiped off the COVID gains, trading at the median levels right now. So, concluding remarks for I would give is, and I will justify my title. If you have that, is it rational behavior to invest in diagnostic space? One second. There are different people, different perspective of money, different perspective of investment returns. If someone is happy investing in a business which is high cash flow generating, high so revenue growth more than industry, no corporate governance issues so far. For a 15% growth, if you are comfortable paying that 45-50, and you are comfortable saying कि ठीक है business बहुत अच्छा है, quality is good, but you are paying high price and you are comfortable with that kind of growth, भाई ठीक है पैसा नहीं बनेगा कितना 12,000-14,000 बनेगा, you have that kind of expectation, because see here the margin of safety is very less. And by margin of safety I don't mean conservatism. margin of safety is not being conservative. Margin of safety is basically increasing your odds in your favor, given a certain level of risk. Here, for a 15% growth, yeah, it is trading at 40, 45, but the quality of business is like that. You can predict the business. Given the history, it is very clear that these companies are not going anywhere. And you can see the valuation. It is trading at peak order. It is not like dirt cheap. If you are in that bucket, think about the business, inject your focus. If you are not in that business, you think that 15-20% का growth मुझे कोई और industry दे देगी, 20-25%, 30% grow हो रही है, at a certain level of valuation below or the same as a diagnostic, then don't think about other businesses. This is not for you. Basically, the diagnostic industry is here to stay, and the players that are there are not going anywhere given the history that we have read. And if history is the correct way to predict or forecast a bit, then I don't see a lot of issues in this industry. Yeah. On that remarks, I'll conclude my presentation. Thank you so much.